Case study analysis on Bank of America. Bank of America. Amadeo Gianni formed the Bank of Italy in San Francisco in 1904. He originally founded the bank because at this time most banks only did business with either very wealthy people or big companies. He called it the People's Bank. The people had never had a bank before. In 1930, he changed the name from Bank of Italy to Bank of America, and also created Transamerica Holding Corporation. Through this and changes in California legislature, he was able to expand his bank to other states, because what his ultimate goal from the name of the holding company Transamerica, he wanted it to be a nationwide bank for all people. This strategy and vision was successful, and in 1929 assets reached over $1 billion. In 1998, Nations Bank and Bank of America were supposed to form an equal merger. Nations Bank kind of took charge of that, and then in 2008 there was the financial crisis, which did affect Bank of America negatively, and a couple years later, they actually were fined by the government for wrongful accounting and misrepresentation. Bank market capitalization. Bank of America is the third largest bank in the United States, behind J.P. Morgan, Chase, and Wells Fargo. They occupy 35 states with 4,708 branches divided amongst those states, and they occupy 229 branches in 35 countries around the world. What else I did for Bank of America was Porter's 5 external forces, going from least threatening to most threatening. New banks, it's very hard in a mature market that's saturated and with all the government regulations for a new bank to really get a foothold and become a threat to Bank of America. Buyers and suppliers are almost one and the same depending on who you ask. Buyers being customers who take out loans and use other products like mortgages. Suppliers would be sometimes the same people that deposit their funds into depository accounts like checkings and savings and high yield accounts. Substitute threat has grown, especially with the increase in technology. Substitute threats include mortgage companies, credit card companies. PayPal is one that has emerged because of the internet. And coming to the last one, competition threat is extremely high, again, because the market is so saturated. There's a few main rivals. J.P. Morgan and Wells Fargo are among them, and the market being so flooded, most people have a bank account, so it's not getting new clients, it's taking them away from other competitors. Bank of America's strategy involves 4 what they call pillars. All of them have to do with growth. Grow to win the market, which means taking customers away from other banks. Grow with our customer-focused strategy, which their customers include, individuals like you and I, small and big businesses. And then the last 2, grow within our own risk framework and grow in a sustainable manner, have to do with growing in the other 15 states that they don't currently occupy, but at a rate that they don't stretch themselves too thin, and they maintain a strong foothold in the places that they do already conduct business. Financial analysis of the banking industry in general is extremely different from any other industry. in America. You do not use the normal ratios that you would with other industries. The specific ones to the banking industry, loan to deposit ratio, which is how effective they use the money they get from deposits in loans to create more revenue. The next one is efficiency, which is kind of like operating margin, and loan growth, kind of self-explanatory, and deposit growth, self-explanatory. Obviously, we want to see both those go up. Return on assets kind of mirrors the loan to deposit ratio, and return on equity has been all over the map. The biggest problem that Bank of America's had is they've not been using their deposits to utilize revenue by using that money for loans. That's also, you can also see that in return on assets, as it is also below the industry average. Again, different from other industries. The income statement is, the net income is made up of total interest income and total non-interest income. Total interest income being the most important and at the top of the income statement. Net income has gone up slowly over the past 5 years. Total interest income and total non-interest income, 4 out of 5 years have declined. They've been able to still have an increase in net income as they offer the lowest return on deposits out of any major bank in the United States. Recommendations for Bank of America is they need to improve and capitalize on their deposits through using more of that deposit money in loans and mortgages to get increased revenue from those deposits. If they do this, because they're such a large corporation, they can use those extra funds to grow a little bit faster into the 15 states they don't currently occupy. And obviously, with new geographic areas, people need new and different products. So also looking at 10-year quarterly revenue, we can see from 2007 up until 2017 that there has been a decline, a linear decline in revenue. And if they don't restructure, or should I say manage their deposits better for revenue income, they're going to see a continued decline in revenue, which ultimately could hurt them and put them further behind JP Morgan and Wells Fargo.